What's up, everybody, and welcome back to the channel. I'm Pablo, and today we're diving deep into financial metrics crucial for any small business owner. I know what you might be thinking. Spreadsheets? Charts? Is this really necessary? Trust me, understanding your business's financial health is essential for making informed decisions. Imagine driving a car without a speedometer or fuel gauge. Scary, right? That's what it's like running a business without tracking your financials. Don't forget to hit that like button, subscribe, and ring the notification bell. First up, we're tackling a metric that's often considered the lifeblood of any business: revenue growth. Revenue growth measures how much your business's income is increasing over a specific period. Tracking revenue growth isn't just about celebrating wins. It's about identifying trends and making strategic decisions. Think of it like this. Revenue growth is the engine that drives your business forward. A healthy growth rate indicates demand and successful marketing efforts. Stagnant or declining revenue can be a warning sign that something needs to change. Now that we understand why revenue growth is so important, let's talk about how to actually calculate it. The formula is straightforward. Current period revenue, previous period revenue, previous period revenue, x 100. For example, if your revenue was $100,000 last year and $120,000 this year, your growth rate would be 20%. That's a solid growth rate. All right. Moving on to another critical financial metric that every small business owner needs to understand: gross profit margin. Now, while revenue growth tells you how much money you're bringing in, gross profit margin digs deeper and reveals how efficiently you're turning that revenue into actual profit. In essence, gross profit margin measures the profitability of your products or services after deducting the direct costs associated with producing them. These direct costs, known as the cost of goods sold, include things like raw materials, direct labor, and manufacturing overhead. Think of it this way: you're selling handmade candles for $20 each. The materials for each candle cost you $5. Your gross profit per candle would be $15. But to get a true understanding of your profitability, you need to calculate your gross profit margin. This is where the magic happens. Gross profit margin takes that $15 gross profit and expresses it as a percentage of your selling price. In this case, your gross profit margin would be a healthy 75%. Why is this metric so important for small business growth? A healthy gross profit margin fuels growth. It allows reinvestment in equipment, employees, and marketing. It also indicates business health and efficiency. Keep an eye on it to protect your bottom line. All right, let's talk about operating cash flow. This is the lifeblood of your business, the cash that flows in and out from your everyday operations. It's different from revenue because revenue doesn't take into account expenses or when you actually collect payments. Imagine you sell a $10,000 product, but the payment is due in 90 days. Your revenue goes up, but you don't have the cash in hand yet. That's where operating cash flow comes in. It tells you how much cash you're actually generating from your core business activities. Why is operating cash flow so important for small businesses? It's a key indicator of financial health. Positive cash flow means covering expenses and having flexibility for reinvestment. It also attracts lenders and investors. Negative cash flow is a red flag. Keep a close eye on it to make strategic decisions. Let's dive into the current ratio. It shows if you have enough liquid assets to cover short-term liabilities. Divide current assets by current liabilities. Current assets include cash, receivables, and inventory. Current liabilities are debts due within a year. A 2-to-1 ratio is generally healthy. It means you can meet short-term obligations. Ideal ratios vary by industry. Now, while the current ratio is a valuable tool, there are some common mistakes that small business owners often make. One mistake is focusing solely on the number itself without understanding the underlying components. For example, a high current ratio might seem great, but if it's driven by a large buildup of slow-moving inventory, it could actually be a sign of trouble. Always dig deeper into the numbers to understand what's driving your current ratio. Another mistake is neglecting to track the ratio consistently over time. The current ratio is not a one-and-done calculation. It's essential to monitor it regularly, ideally monthly or quarterly, to identify trends and potential issues early on. Finally, don't rely solely on the current ratio. It's just one piece of the puzzle when assessing your business's financial health. Combine it with other metrics and insights to get a comprehensive view of your business's performance. Remember, understanding and effectively using the current ratio can help you make informed decisions about managing your cash flow, securing financing, and ensuring your business's short-term stability. Let's talk about a crucial metric for your marketing efforts: customer acquisition cost, or CAC. It's the average amount spent to acquire a new customer. Calculated by dividing total marketing expenses by new customers. For example, $5,000 spent for 100 new customers equals $50 CAC. Understanding CAC helps determine your marketing ROI. Track CAC to identify trends and optimize strategies. Tracking your CAC over the long term offers several benefits. First, it allows you to make data-driven decisions about your marketing budget. By understanding how much it costs to acquire a customer, you can allocate your marketing spend more effectively and focus on the channels and campaigns that generate the highest ROI. Second, a lower CAC can lead to increased profitability. If you can acquire customers for less, you'll have more profit margin on each sale. This is especially important for businesses operating in competitive markets where margins are tight. Third, tracking your CAC can help you identify your most valuable customer segments. You might find that certain marketing channels or campaigns are more effective at acquiring high-value customers. With this knowledge, you can tailor your marketing efforts to attract more of these profitable customers. Ultimately, understanding and optimizing your CAC is essential for sustainable business growth. By keeping a close eye on this metric, you can make informed decisions that will maximize your marketing ROI and drive long-term profitability. Now we're getting into customer lifetime value, or CLTV. It's about understanding how much a customer is worth to your business over their entire time with you. Would you rather have a customer who spends $100 once or $50 twice a year for 5 years? That's the difference between a $100 customer and a $500 customer. Acquiring new customers is expensive. It's more cost-effective to keep your current customers happy. By understanding CLTV, you can make smarter decisions about spending, pricing, and loyalty programs. A high CLTV means your customers are happy, leading to more revenue and growth. So, how do you actually improve your CLTV? Over-deliver on customer service. Go above and beyond to make your customers feel valued. Build a strong brand identity that resonates with your target audience. Implement a customer loyalty program. Reward your loyal customers. Personalize your communications and offers to their individual needs. Personalization can go a long way in boosting your CLTV. Now, if you're dealing with physical products, this one's for you. Inventory. Turnover tells you how efficiently you're moving your inventory. It measures how many times you sell and replace your inventory in a year. Higher turnover means you're not sitting on unsold goods. Think of $50,000 worth of inventory just sitting in a warehouse. That's money tied up, not working for you. Every day it sits there, it's costing you money. Turn it over quickly and you're generating more sales. The ideal ratio varies by industry. Compare your turnover to industry benchmarks. Are you lagging behind or are you efficient? So, how do you optimize your inventory turnover and keep things moving? It all starts with accurate forecasting. Understand your historical sales data and seasonal trends. Predict how much inventory you need to avoid overstocking or understocking. Consider a just-in-time JIT inventory system. Minimize holding costs by receiving goods only as needed. Coordinate closely with your suppliers. Regularly review your inventory for slow-moving items. Discount these items to clear them out. All right, let's talk about leverage. And no, I'm not talking about negotiating your next car purchase. The debt-to-equity ratio tells you how much debt your business is using compared to equity. It shows how much of your business is funded by borrowed money versus your own money. Debt isn't always a bad thing. It can be a powerful tool for growth if used strategically. Debt can help you invest in new equipment, expand operations, or hire more employees. However, too much debt can put your business at risk. A high debt-to-equity ratio means your business is relying heavily on borrowed money. It means higher interest payments and difficulty securing additional funding. A low debt-to-equity ratio is generally seen as a sign of financial health. It's all about finding the right balance. How do you use debt strategically for growth? Understand your industry and risk tolerance. Some industries need higher levels of debt. Research industry benchmarks and compare your debt-to-equity ratio. Have a solid business plan. Understand fund utilization and repayment. Lenders want to see a well-thought-out plan. Shop around for the best loan terms. Compare offers and negotiate favorable terms. Track your debt-to-equity ratio closely. Monitor financial statements and adjust strategies. Use debt as a tool for growth, not a burden. All right, we're getting close to the end of our list here, but this next metric is a big one. We're talking about net profit margin, which tells you how much profit you're actually keeping for every dollar of revenue you generate. Massive revenue with out-of-control expenses means a tiny net profit margin. And a tiny net profit margin means you're working your tail off for not a lot of reward. Tracking your net profit margin is crucial. It gives you a clear picture of your business's overall financial health. A healthy net profit margin gives you more financial flexibility and helps build long-term wealth. Let's look at two coffee shops, both generating $500,000 in annual revenue. Coffee Shop A has a 5% net profit margin, keeping $25,000. Coffee Shop B achieves a 15% margin, keeping $75,000. This shows the importance of focusing on profitability, not just revenue. Coffee Shop B can reinvest more, and the owner takes home a larger profit. Finally, we've arrived at the last key financial metric: return on investment, or ROI. ROI measures the effectiveness of your investments, whether it's money, time, or resources. It tells you how much bang for your buck you're getting. You wouldn't just throw money into a stock without expecting a return, right? The same goes for your business. Every decision should yield a positive return. Calculating ROI is straightforward. Subtract the cost from the gain, divide by the cost, and multiply by 100. For example, a $1,000 investment generating $2,000 in sales gives a 100% ROI. ROI isn't just about cash. It can measure time investments too. One of the most valuable aspects of ROI is its ability to guide your decision-making process. By consistently tracking ROI, you can identify which initiatives are generating the highest returns and prioritize those areas. For example, if you're running multiple marketing campaigns, ROI can help you determine which channels are most effective in attracting customers and driving sales. This data-driven approach allows you to allocate your resources more efficiently, investing more heavily in strategies that have proven successful, and scaling back or even eliminating those that aren't delivering the desired results. Remember, every dollar you invest in your business should be working towards maximizing your returns. But ROI isn't a one-size-fits-all metric. It's important to consider the context of your specific business and industry when evaluating ROI. Some investments, like those in research and development or brand building, may take longer to show a positive return, but they can have a significant impact on your business's long-term growth and profitability. That wraps up our breakdown of the 10 key financial metrics every small business owner should be tracking in 2024. Remember, understanding your numbers is not just about crunching numbers. It's about gaining valuable insights into your business's performance, identifying areas for improvement, and making informed decisions that drive profitability and growth. Whether you're just starting out or you've been in business for a while, these metrics will provide you with a solid foundation for financial success. For a more in-depth look at each metric, including formulas, examples, and industry benchmarks, be sure to check out the detailed blog post linked in the description below. And as always, if you found this video helpful, please give it a thumbs up, subscribe to the channel for more valuable business and finance tips, and hit that notification bell so you don't miss any future uploads. Thanks for watching, and I'll see you in the next one.